Hey everyone, welcome back to the channel. Today we're going to take a quick look at Peloton. Um, their stock has done really well in the last, call it a year or so. I'll pull it up real quick. We can just kind of take a little look together, see how things have gone for them. And that pulled up Netflix. There we go. So you can see in the last year from 25 a share to 150. So they're up, what is that, 7 times almost, 6 times. So I pulled all their financial information. You'll see pulled over their income statement, balance sheet, and statement of cash flows. So we'll go ahead and we'll link it up in here, and then we'll try to make some projections for, I guess we're gonna have to project 2020. Oh no, 2020 is in there. So 2017 we don't have. But we'll link this up real quick. Shouldn't take too long to get this going. And then we can hopefully go from there and see what kind of makes sense on their different products and see how the growth could really play out for them, and see if this valuation is crazy or not. SG&A, let's see, what do they have? So they lump in R&D. We'll just lump R&D in there. It seems pretty minimal in comparison, so we can leave that in there. And then D&A, let's see, this should be on the cash flow. Oh, I didn't rearrange the columns, so sorry about that. We're gonna have to link those one at a time. Let's make sure that those symbols are going the right way. EBITDA, yep, EBIT. Taxes, I think this is just calculating based off the below. Yep. Um, so I mean, they're not going to be getting massive tax credits. I actually think their taxes may be on the income statement. Let's see. So they paid 3 there. I don't think they paid anything in the other ones. Very minimal amount. And then that's going to add back CapEx. We're going to plug CapEx down here. That should be on the statement of cash flows as well. So there's 18, 19, and 20. Cool. So now that we have this set up, we can kind of run a little bit of analysis, and I guess working capital is the last thing here. So we can calculate, let's see, current assets. This only goes to 19, so we'll see here. What do we have? We want AR, we want inventories, and we'll take prepaids. So we can copy that over. And then liabilities we'll take as well. AP, accrued expenses, customer deposits, and we're not going to do the lease liability, so we'll do that. And then that should calculate the change. So yeah, they're getting a big source of cash from, what is that on the current liabilities? That seems a little weird. AP, accrued expenses, customer deposits, so that's the big. They're bringing in a lot of cash, so, but I mean that'll, I guess it'll, yeah, interesting. A lot of pre-orders, I guess, people trying to buy it ahead of time. So first we'll go ahead and kind of look through this. So the subscription revenue, I think, is really where the good COGS is. Maybe not. Oops, let's see. I would I expected the subscription to have better margins than selling the bicycles, but it looks like, I mean, it's better, don't get me wrong, and it's been improving drastically. And obviously, as it scales, it'll continue to go down. But connected fitness revenue growth is pretty nuts, and COVID definitely played a big part in that. The question is, can they kind of maintain that? And I mean, honestly, I think COVID is going to maintain this year for 2021. So I'm going to give them credit for that, and then we're going to drop them down to like a, that might even still be, it's tough to say what they're going to be at here. And obviously, I think that the subscription growth rate has to at least be that of the connected fitness growth, because every bike they sell a membership with it. And then on top of that, they have their app. So what I'm going to do here is I'm going to take this and I'm going to add 1% to whatever we're putting there, and say that that's going to be, the 1% is going to represent users that just download the app. And I'm getting that just looking at this, it's about 1% higher. I mean, here it's 20% higher. Um, so they were selling a lot of the app, but then kind of switched to the bike. So we'll give them a little bit of credit there. And then we're going to have them taper off pretty quick here. I mean, I don't know how many more bikes they can sell every year, to be honest. So we'll see. And then we'll leave them in like a low single digits. And this is just a first pass. We'll see. Maybe this doesn't make any sense and they're not profitable with something like this. So we'll see. But I think it makes sense that it's going to be COVID in 2021 for most part of the year. I think you're going to see a lot of people still buying bikes. I mean, to me, this looks crazy. I don't think they're ever selling $15 billion of new hardware a year, but they introduced a new bike, they're introducing a new tread, there's rumors of a rower. So I think there's a lot of ways they can still kind of accelerate this revenue quickly. So I'll give them credit for that for now. COGS, I mean, this has been steady around 57%, so I'm going to hold that constant. And then this one's actually decreased, but decreased heavily. I'm actually going to have it, we're going to have it decrease 2% a year because this is their app, right? So like once the app is up and running, like sure, you got to make some content for it, but that should scale over time as you have more users. It should be less of a percentage of the sales. It should be closer to a fixed cost-ish. It shouldn't be as dependent on per dollar of subscription revenue. So from that standpoint, let's see, there we go. And then the COGS, multiply that out here real quick. Kind of see what we get here. And we'll see if they become kind of a cash flow positive company or what's going on. SG&A, around 50%. I mean, they spiked here in 2019, back to 50%. I think if we look at it, their SG&A costs actually, yeah, like selling, marketing, and G&A. So they just really expanded their corporate functions. I know they're still doing a lot of hiring, but we'll leave it at 50% for now. There's definitely some room for improvement there, but we'll leave it for the time being, and that's on a percent of total revenue. And part of that, honestly, with the subscription revenue, that should actually end up coming down eventually, I think. So maybe leaving this at 50% is a bit much, to be honest. They're going to have to see improvement there, but because as the subscription revenue grows, this isn't going to grow in line with that. So we're actually going to, let's see. Yeah, no, I mean, their SG&A is going to double just because their revenue doubles again. So maybe it normalizes out, right? So, I mean, this leaves their SG&A growing a little bit, but it should not be growing at the same rate as sales now that they've kind of got through this initial ramp. I would expect them to kind of slow down on that growth trajectory there for SG&A costs. And I mean, kind of steady stated out almost. Like, I mean, it's still growing significantly, but we'll leave there for now. CapEx as a percent of revenue. I mean, it's been hovering around 9%. I'm just going to hold it constant for now. And then we'll just do this. Let's get the CapEx number here. And then is that linked up? Now D&A as a percent of CapEx. This should actually slowly grow over time because they're going to have less growth CapEx eventually. It's not going to grow super quick per se, but it will grow over time for sure. But then now we can calculate this as a percent of this, and we'll just flip the sign on there, and we'll see how that kind of plays out. We'll link that up real quick. And I mean, honestly, that's probably a bit much. Like, saying $1 billion of capex a year, like, I think this needs to decrease as things kind of increase here. I don't think they're ever going to hit. I mean, I worked at a Fortune 100 company, and I think our total company had 300 million of capex, and we did 20 billion in revenue. So I don't think they're just going to have this crazy capex that's going towards $1 billion a year. That would be a little bit nuts. So we'll steady state them at like close to like 400 million-ish. We'll just see how that kind of, yeah, have it taper off at the end. And I mean, this might even grow faster than that as they kind of get rid of, it'll be more maintenance capex than growth capex over time. That's kind of surprising these things stayed about equal, but this needs to decrease over time. We're going to assume over time they are going to get better at delivering their products, and then it will taper out close to where their current assets are. So the reason for that, if I just walk you through the thinking here, what I'm really saying is over time, because right now the big part of their current liabilities, if we come back to their balance sheet, is this customer deposits. That's because they can't deliver the bikes in time. So once they get their production figured out after this large COVID spike, they should be able to deliver the bikes. This will go down. They're not going to hold such large deposits, and their current liabilities is going to decrease. And I don't like giving companies a ton of credit for like cash flow for working capital. And I mean, here you can see I'm actually taking from them quite heavily, which I think is fine. And you know, maybe that's aggressive. Maybe this shouldn't be 5%. Maybe we leave it at 2%. Let's see, what is this doing? That seems weird. That's why it's off the wrong revenue number. That makes much more sense now. I was like, why is that so high? We shouldn't see a crazy swing like that. Let's see. So now as it grows, we see a little bit more of a linear growth here. Let me just make sure that this is linked up right. Nope, it's not. Okay, so that's also part of it. So now it's linked up to row 6. Okay. And then this one should be linked up to row 6 as well. All sorts of wonky things going on here. Okay, so now you'll see they do get big credit here just because is this linked up right? Sorry guys. And it's not. Oops, that's why the percentages are all off and things are looking a little weird. So let's, current liabilities, this percent of revenue. There we go. Now things should kind of normalize out. And then now if we look at the cash flow, I mean, it gets a little wonky in a couple of years here, but you know, we're giving them some credit here, but then it kind of dies down, reverses out. It gets a lot more normalized per se. So based off this, let's do a 10% WACC. I get a lot of questions about WACC. and how I come up with that number. This is really like when I think of WACC, it's the number you would require as an investor to invest in this company. Um, so with that being said, like I would need a 10% return because that's the average of the S&P 500, um, simply put. So you can agree or disagree with that. You can kind of come up with your own WACC. Some people like to look at the company WACC. I think that's a little silly. Um, I mean, what it costs the company to raise capital. I mean, they use that on like an internal ROI, and that's what they should be hitting for. Otherwise, they should, invest elsewhere, return money to investors, something like that. Um, and I mean, you could be like, oh, I want to discount their cash flows that I'm projecting at, their cost of capital to get value today. But really, the WACC is what return do you require? If you require 15% return because you think it's risky, then it's going to lower the value of the company. If you think they're less risky, it's really kind of your opinion and what return you would require for this. Terminal growth, it's pretty straightforward. Usually just set close to inflation. Sorry, I got to remove a couple of these commas in here. So then enterprise value. So I mean, 31 billion less net debt. So if you're not familiar, net debt is debt less cash. So let's come on here. Let's look at liabilities. I don't even see debt. Do they really not have debt? That seems crazy. Yeah, I'm not seeing debt on here. So I think we would just, yeah, they seem pretty cash rich. Oh, actually, I guess I want this to be D4 plus marketable securities. But yeah, I'm not seeing debt. I mean, I guess you could argue customer deposits or debt, kinda, but not really. I'm looking for like banknotes, bonds. So yeah, they just have cash, so you're actually gonna add that back. That's exciting. That's gonna increase their market cap. And format this real quick so we can. So our projections currently give us a $33 billion valuation, and that's pretty healthy. I mean, that's assuming they're going to get to, what is this, 15 billion, $18 billion of sales. That's crazy. Um, I don't know if that's possible. And I mean, if we look at their current market cap is 44 billion, so the market's even more aggressive than this. Um, Honestly, I think 2019 is probably a fair representation of their annual sales. The reason I say that is I think during COVID, a lot of people went from working out in a gym to working out at home. So you had a lot of people purchase their bikes. And I think if you were to, if you were to just even, I mean, if you held them, right, like in my, you know, personally, I would say you hold them something like this. Um, right at that 2019 kind of numbers. Um, and you could argue, okay, maybe you don't have to decrease the connected fitness because they are selling a lot of subscriptions and those are annual, right? So kind of every year that base is going to grow based off what the top line grows as well, in a sense. So, but I mean, something like that, I mean, you're looking at a $5 billion company. I think that's much more reasonable. Um, I mean, if we think about it, right, when they're 20 bucks a share, you cut their market cap in sevenths. So 44 divided by 7 is what, 6? They're a $6 billion company back then. And that's just back in March of this year. Um, and that's much more in line with what we're at. So, I mean, the question really is, can they sustain the growth rate that COVID has brought, or has COVID accelerated future growth into the year of 2020? That's the question to find out. So there you have it. Thanks for tuning in. Hope you found this helpful. And yeah, thanks so much. Let me know if you have any questions or comments in the comments below. Thanks.